Hi everyone, welcome to the channel. Today we are going to discuss about this concept called materiality. So, in simple terms, materiality is something that something like a value you can say. So, if you are a user to a financial statement, okay. So, if we as a person are trying to invest in a company or looking to invest in a company, and then you take you pick you select you take the financial statements of that company, and then you see that the revenue for that company is like 10 lakhs. You think, okay, the revenue is 10 lakhs, and so we are seeing the performance of the company, and we know that this particular one of this parameter was going to influence our decision. So we see that, okay, the company's revenue is good, and we feel like investing in the company. Like, this is one of the parameters. But then if there is one of the invoice which was missed when the company was recording its revenue, so suppose if that is like 1000, okay, uh so do you think this particular invoice which is missed will affect your decision or impact your decision? Because it's only 1K, and the amount which is there is like 10 lakhs is the revenue. So this is like very judgmental, okay? Because this in this case, the user of the financial statement is an investor who's trying to invest in the company, and then his purpose is to see what is the performance of the company and all. So when he is seeing, like, his decision is not very much impacted if the company intentionally or unintentionally misses this invoice, which is only 1000. So it depends. So this is like, in this case, this 1000 is not material. So this materiality concept is very important because it also plays an important role for the auditor also. When the auditor also is planning his audit, so he has to consider this materiality, because it is very difficult for the auditor to do 100% of the audit, or to give a complete assurance that the financial statements are completely true. So the auditors only give a reasonable assurance that the au- this and that the financial statements are fair and all. But because no one can give complete assurance, it's very difficult to go through 100% of records of the company. So what the auditor does is, auditor at the planning stage, or at the time when the auditor is starting his audit, based on the parameters, different parameters, or based on the type of the company, the auditor assesses amount which is called like a materiality amount, based like in that case, what he is like, the auditor's point of view is that if this amount is below this, if there's a misstatement, or if there is a like a error up to this amount of 1K. In this, in our example, the amount was 1K dollars, right? 1K rupees. So in this case, if there's something which is misstated, he's of the opinion that this particular misstatement or particular omission will not affect the user of the financial statements. So based on that, the procedures of the audit are designed. So like, there's a lot of factors on which this materiality, assessing the materiality takes place. It depends if it is like a profit before tax is like a so suppose if in our now, if you're trying to assess the materiality for a particular company, where for the company that revenue is 10 lakhs, okay, and the profit before tax is like 4 lakhs, you think. So in this case, suppose one of the ways where the materiality is assessed is, it depends, okay, like percentage, like the normal range is like, it depends on 3% to 10% of different factors, okay. Some people take, like, if it is like a company which is like fully dependent upon its profits, or like a substantial amount, like substantially, it is like it's like a continuing company where it's generating profits and all, we normally take like 3% to 4%, depends, it's like judgmental on a lot of factors. So in this case, if suppose we are taking like, if we're taking like a higher end of 10% of 4
till
lakhs.
December or early January.
Yeah. So in this case, if you're taking 10% of 4 lakhs, so that is 40,000. So we are saying that for this particular company, this materiality is 40,000. So we are judging that if a particular user of the financial statements opens his financial statements, and if there's an entry which is like up to 40,000, if the company forgets it, or if something is misstated up to 40,000, that's not going to affect the decision of the user significantly. So that way, uh, the materiality is assessed. Okay. And then, like, if it is like a companies in profits, they use profit before tax. If it's a loss making company, they use the losses value. Or if it's like an investment company where the major asset is their investments, the net assets is used. So it totally depends upon the nature of the industry in which the company is in. And then I told you earlier also, right? It's like the percentage totally, it's like it depends, because but if it's a listed company, the lower end is taken so that to be on a conservative basis, so that if the lower the materiality, then not lot of value is missed, and the high chances that we don't miss anything, and everything is being considered properly. So that is there. And then if it's not a listed company where public is not substantially interested, or public money is not invested, then we can like higher percentage is taken, up to like 7 8% or 10%. If it's a private company also, mostly up 9 10% is taken. So it depends on a lot of factors. If the particular company is like a regular if the company is like a continuing audit, and we have there's no history of past errors or misstatements, and then there's proper controls which is there in the company, and the controls are very effective and all, then up to 10% can be taken. But then there's some errors, or there's something where a lot of judgment involved in that particular account, in that particular entity, or there's some mergers acquisitions that's happening and all. So there's a lot of complex things that is there. Then it's better to be a bit conservative and take a lower percentage when you're assessing the materiality. So yeah, so like that it is. And uh, it's very important that we assess this for the auditor, because it is very helpful for them to plan the audit and design the audit procedures. Yeah, if there's something which you have any doubts or something, you can just give your comment below, and then I can take a look and get back to you all. Thank you so much.